right? So my macro in the crack spread is bearish, right? So I want to be short oil. So based on the fact that we've got a straight line, that tells me there's supply on gasoline, correct? Yes, that tells me there's supply in gasoline. Because the oil price is the same, so how can the crack spread be lower? There must be supply on gasoline. So it's the only way the crack spread can be lower. So if there's supply on gasoline, am I not starting to get a story that I definitely want to be short into? Absolutely, right? So I want to find that bubble forming where the oil is exposed. I want to find the bubble where the oil is exposed. Now, when the crack spread starts rising, at that stage, now I'm starting to think to myself, with the crack spread rising, this is definitely what I'm looking for, because when the crack spread rises in the short term, that's normally because traders who trade the crack spread must believe oil prices are going to fall in the short term. So the crack spread is normally a negative correlation, right? In the short term, and it's a positive correlation on the macro chart and a negative correlation in the short-term charts. So the short-term trade, the crack spread rallies. So my first thought is, let's start selling. Let's start selling off a macro level because the macro is short. The macro is short. So I start looking inside of that to find the opportunity, which is going to be a divergent oil price to the gasoline price. And that's why I add in the purple line and the black line. You don't have to add in the black line, just add in the purple line to get started with. The blue line should be divergent from the purple line. The blue line should be rising against the purple line. Is the blue line rising against the purple line? Yes, it is. So now we know oil's overpriced. Now we know oil itself as a standalone product. Because of that gap that comes in here, we know oil is overpriced. The same way as we knew during this gap that formed in here, we knew that oil was overpriced. And we could start sailing into that phase, which obviously did drop. It didn't drop much, but it did drop. So we could have taken that trade as well. So, but when I see a gap forming like this is very powerful. Very powerful indeed. I like this trade a lot. And obviously, as we add in the black line, it's going to be somewhere in the middle. It is somewhere in the middle. It's always somewhere in the middle. So we understand the black line is somewhere in the middle. And the black line's diverging as well. So what does the black line divergence mean, Everett? The black line, remember, is the percentage, not the actual dollar value. The black line divergence means that there's going to be sellers, macro sellers coming in the crack spread. The macro sellers in the crack spread are likely to take advantage of that higher crack spread price because it's overpriced. It's overpriced. So I trade the blue line to the black line. So if the blue line is going to go to the black line, I know that there's an advantage overall for me to get short oil. And obviously when the short oil comes in, the big pop on this is because of the drop in oil prices. The big pop on this is because of the drop in oil prices. And that's why we were able to get a massive $1,600 sell-off. Do you see how that plays out? It's beautiful. An extra long contract. Let's do the sums. If I sell the blue line, what am I selling? If I sell the blue line, I'm selling RBOB. Yes? So therefore the sum is minus RBOB plus oil. Yes or no? Okay? If I buy the purple line, what am I buying? What's the formula if I buy the purple line? I'm buying RBOB and I'm selling to oil. Yes? Is that the formula, everybody? Everybody happy with that? Everett's got it? I'm buying RBOB and I'm selling to oil. So if I'm selling one RBOB and I'm buying one RBOB, RBOB's cancelled, correct? If I'm buying one oil but I'm selling two oil, how many oil positions have I got? How much supply or demand is coming in? If I buy one oil and sell two oil, I am supplying the market with one contract of oil in that trade. Supplying the market with one contract short oil. And that's going to drive the oil price down, isn't it? Make sense? So when you look at the simple arithmetic on that, you start to say to yourself, yep, that works for me. That works for me a lot. That's a really good trade. And that supply of two contracts, net one contract, that supply should show up in this volume, shouldn't it? Do you agree with that? That two contract supply should show up in this volume here. It should show up in this volume here as a sell. In other words, it's a passive sell at higher prices. And we should see that extra oil contract become visible in the volume contracts, right? So we start to recognize that this is a short supply of oil coming in, and we recognize the supply coming in from the volumes, and then we sell oil into that. And sure enough, boom, straight down for thousands of dollars. Does that answer the question, Everett?